One of the best arguments for owning physical gold is that it has stood the test of time. But what about the time we live in right now in the modern world? Well, what I'm about to share with you very well could be the best use case for holding the physical gold in your possession. Let's talk about it as we explore. There's more to gold than meets the eye, but I tell you what, meeting the eye with the beauty of gold is unmatched by any other metal with its unique hue, and there's something about this metal that is just quite intriguing and alluring, and that has been the case for thousands of years. But I believe having the physical metal in your hand is invaluable. There are certainly risks involved with that. I'm going to get into some of those risks here in a while. But first, I want to talk about one of the best cases in this modern world in which we live for holding the physical gold in your possession. And one way you can do it is these little wallets from Summit Metals. And this is a unique way to store your precious metals, especially with these cute little Scottsdale gram bars. And really, they're not really cute. They're actually just pretty cool. And I am on my way to filling this up. It's been a slow process, but eventually I will do it. And so Summit Metals has these for sale, so check them out at summitmetals.com. I'm going to be referencing a piece here from ainvest.com that makes the case for holding physical gold as opposed to paper gold. Now remember, it's really about overexposure to paper gold. In fact, that's really what they're talking about here, the perils of overexposure to paper gold. I don't think they're necessarily against holding paper gold, and I'm not either. But I do believe that we should have a physical allocation as well, especially considering that we live in an era where global public debt has surged to a record $102 trillion. And actually, that seems kind of low. But nonetheless, when you see our federal debt is more than a third of that, it is now above $37 trillion. Investors face unprecedented risks to their wealth. As systematic fragility deepens, reliance on financial instruments tied to debt-laden currencies grows increasingly precarious. Among the most misunderstood vulnerabilities lies the overexposure to paper gold, which promises the safety of precious metals while exposing investors to systematic collapse. And so that is what this is about. Of course, understanding what paper gold is or buying ETFs, you're exposing yourself to the price of gold, not the physical gold itself. And there's some that don't understand that, but I think that whenever you do trade in those markets, you have to come to grips with that because you're not going to get the physical. You can't just say, hey, I want my gold. You know, it just does not work that way. And most people don't want that. They want the idea of being able to be exposed to the price of it and be able to and get out quickly if they need to, or get in quickly. Now, what about this systematic debt crisis? It essentially is a perfect storm brewing for financial assets. And they are staggering, these numbers are. Global public debt is projected to hit 118% of GDP by 2035 for the entire planet, with net interest payments consuming 4.1% of global output by the end of this decade. For developing nations, the strain is existential. 61 countries now spend over 10% of government revenues on interest alone. That is staggering. While 46 allocate more to debt servicing than to healthcare or education. These figures underscore a reality. The global financial system is operating on borrowed time and borrowed money. In fact, in reality, both are luxuries that they have for a while, mainly because it's propped up by the United States. The dollar's hegemony is a debt-induced system, and they're just going to perpetuate itself. So if the United States can do it, well, the rest of us can too, and that's exactly what's happening. So in such an environment, paper gold, such as ETFs, futures contracts, or mining stocks face three critical risks, according to them. But I think mining stocks, in a sense, is in a world itself because really it's just you're investing in companies that just happen to operate using gold. So the the risk in trading those stocks, I think, are more in line with the risk of investing in the stock market. But obviously, all of them have a dependence on the counterparty. Paper gold requires trust in financial intermediaries. If banks or ETF providers fail, investors may find their claims unfulfilled. That's true. Unlikely to happen, though, anytime soon. So understanding that as well is something you have to think about. But it is something that we have to keep in the back of our mind, just as a case of a currency collapse could happen, too. Then there's liquidity traps. During crisis, paper instruments can become illiquid. Although I don't know that I necessarily agree with that, too. People can move money around very, very quickly with trading apps these days, and they do it. The 2008 collapse of Lehman Brothers and the 2021 GameStop short squeeze illustrate how systematic stress disrupts financial instrument violations. In fact, during the GameStop situation, it was Robinhood, the trading app, that shut it down. That was a very, very big deal back then. Of course, you don't have that with physical gold. It's in your hands. And there's drawbacks to it, too. I'm going to get into those drawbacks for holding physical because there are some. We have to look at both sides of these issues here. And so that is something that is certainly something we need to think about what's going on. The third one is market manipulation. The London gold price fixing scandal of 2014 and ongoing allegations of central bank gold leasing schemes highlight the vulnerabilities of price distortions. Of course, we know there's market manipulation everywhere. Holding physical gold is not immune to that because they're priced in dollars. So that's something that's going to be us for sure with us. But really, in the sense, the ultimate safe haven is holding the physical. And, I'm talking about gold here, but much of this, not all of it, applies to silver too. The silver is more volatile all around, and the premiums are higher, and there's more risk in holding the physical than not. But let's talk about the benefits to holding the physical gold. And some of this is really going to be earth-shattering as to what this case they're making here later here in the video. So you're going to want to stay tuned for it. Physical gold and silver are the only assets that hold no counterparty risk. Their value derives from the intrinsic properties, not promises from banks or governments. However, there is single-party risk. And you got to understand that because single-party risk for some may not be worth it compared to the counterparty. They may trust the counterparties more than the single party. What is that single party risk? It is you, the holder of these metals. It is up to you to secure them. And it is up to you to be able to hold them and care for them so that in the time that you need to sell, you're not going to lose any money. Because the risk of holding it for a short time very well could be greater than liquidating in that time because of the lack of you're going to be probably be paid less than spot for it at the time of selling. And you're going to pay a higher premium for them when you buy these physical metals. That's risk. You have to understand that risk whenever you buy the physical. To me, it's worth it by a long shot to engage in that, but I understand those risks, and you should too. But yeah, so whenever you hear somebody say there's no counterparty risk, not very often. In fact, I'm one of the few channels, maybe even the only channel, that has mentioned the term single party risk. And that is a very big deal. And not only in terms of liquidity and where you could literally lose money on gold, and it can happen, and it has happened to folks, and silver to an even greater extent. But also, you have to understand single party risk also means protecting your metals from theft. And more importantly than the metals, yourself, especially if you have them stored at home, and a burglar comes in and it turns into a robbery where there may be an injury or even death to you, and then they take your precious metals away. That is a big freaking deal, folks, and you have to understand that and take that extremely seriously. I know that from firsthand experience. Protect yourself. Protect your metals. Very valuable. So, and the other thing is we have to understand that that physical gold, in a sense, is tangible insurance. It is an insurance policy, not just a savings vehicle, but it is an insurance policy, having the physical in the form. Historically, gold has outperformed fiat currencies during hyperinflation. We know that post-World War II in Germany, and the stagflation crisis in the 1970s here in the United States. Then we have to resist systematic contagion. Even in a debt default cascade, physical metals remain a universally accepted store of value. Indeed, that's right. So this is something that we should consider for probably the best case for holding it in physical form. The gold to debt ratio has plummeted. When we consider this, it is staggering. Think about it. Back in 1980, global public debt was roughly 2 times the value of all above ground gold. That's it, just 2 times. And of course, that was still bad, no question about it. There's been a public debt crisis for a long time, and really it was there in 1980 as well. Now today, it is over 20 times. The global public debt is 2 times of the value of 20 times now above the all above ground gold, above ground gold. That is staggering, folks. That is probably the best case that I've ever heard when you think about that statistic for holding gold. And believe you me, they've mined a lot of gold from 1980 until today. And I think that's another reason why some of these central banks are holding it. I don't think it's all because of what Russia is doing, invading Ukraine. I think there's something in this I think is quite valuable. We also have interest rate pressures as central banks hike rates to combat inflation. Debt servicing costs balloon, and the United States alone pays $1 trillion annually in interest by 2025. In fact, there was a time where our debt was increasing by $1 trillion every 90 days. It's crazy. But now we're paying $1 trillion annually just to service the debt, a burden that could push gold higher as fiat currencies depreciate. And they will depreciate and have. We can bet your bottom and top dollars on it. Every single dollar you own, you can bet that the United States will continue to devalue our currency, robbing us, and not even robbing us blind. It's in full view for all to see. So this is why holding physical gold and paying those premiums and taking on that single party risk is worth it. And it's not to say that you shouldn't diversify within the precious metal space and expose to gold's price and buy ETFs. I'm not saying that at all. But I think it's imperative for us to have some gold in our portfolio if you want to protect yourself against economic instability and all the other risks that are out there. So that's why we need to do it. Now, we understand that there's a lot going on in the world today, and there's a lot of different options, more options out there now to invest your money and to even hedge your money than ever before. But nothing compares to owning the physical form of gold and, by extension, silver. So I hope you found this video informative, insightful, and educational. Would like to extend a multitude of gratitude to each and every one of you for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.